Churchouse, author and publisher of Asia Hard Assets Report. More on the Chinese and Hong Kong property markets. Peter, hi.
Yeah, good to see
now
you.
let's stick with the Chinese property market first. We have recently seen home prices over in China on the up and up. I think in the major cities like Beijing, prices are up about 0.5% for the month of December. The property inflation, will this trigger measures, more cooling measures from the government?
Well, yes, we have seen the cooling measures take effect last year. For example, you saw property transactions slow down quite significantly, and for more than half of the large cities in China, property prices were going down month on month through most of last year, until the last quarter when we started to see prices stabilizing and picking back up again. So we're really caught in a policy-driven market in China. On the one hand, China needs to boost domestic consumption, and housing is a good way to do that. It ticks lots of boxes on the domestic consumption front, and it also ticks lots of boxes on the social front as well, by providing, particularly as you were just mentioning, low-cost housing, which is really in dire need in China. So housing, I think, will be the policy focus going forward.
Right. Peter, this is Dee in Singapore. Now, we have seen a markedly different performance from the big property developers versus the smaller ones, a lot of them which are going bankrupt. How are some of the bigger developers getting around some of the curbs and restrictions, if they are getting around them in the mainland, to keep their profits up and these remarkable performances that we have seen over the last few years despite the restrictions?
Well, that's right. Last year we saw the property developers from China listed in Hong Kong put on about 75% in terms of share price gains. They're growing at about 20 to 25% earnings growth, even last year under a difficult policy environment. Particularly the companies that are listed in Hong Kong have advantages over their domestic brethren insofar as they can access capital in a wider range of capital sources. Some of them have been raising money in the bond market, some have been raising equity, some have been tapping bank loans in Hong Kong. So they are at an advantage to many of their domestic brethren. The industry is hugely fragmented. The top 20 developers in China account only for about 12 or 14% of the total housing production. So it's a very, very fragmented industry, which I think the government wants to see consolidate.
Now, Peter, we're doing some reading here, and the Chinese government, regulators want to ensure loans going to cheap housing. Now, is there going to be a problem to make sure that the loans stay with the cheap housing, and what is that going to be doing to property prices? Yeah,
I think there's definitely a policy to drive towards the lower end of the market. It's a very socially responsible thing to do, and they do want to prevent the sort of speculative investment that we've been seeing over the last couple of years. But China being China, there will be ways around it. They will, the money will probably siphon off into areas which were not intended, as we've seen in the shadow banking system in China, which is now accounting for about 20% of total lending. There are ways around things, and that is the danger. Yes, it's all very well to legislate or have policies to direct money in certain areas, but it doesn't always find its way into the areas as desired. So I think that is a risk.
Peter, as we know, in the mainland, property and lack of access to housing is a major source of discontent among Chinese citizens. Do you think that social unrest regarding the property sector and ordinary citizens is a big risk for the Chinese economy in 2013?
Well, it has been all over the last couple of years or so. You know, in China we hear stories of well over 100,000 protests and demonstrations and riots and so on that never get talked about in the Western press. Most of those riots and discontent is about land and about housing to a greater extent. So yes, it is a very strong and important underpinning of social conditions in China right now, and that need for housing is going to grow. We estimate there will be a demand for urbanization in China to the tune of 50 billion square feet of residential property over the next decade. That's 50 billion. That's a huge amount of floor space. And that's just from people migrating from the countryside into the cities. So you add on top of that redevelopment, upgrading, obsolescence of old properties. So the demand for housing is going to be very, very substantial. So it's a good market for companies to be in because there's going to be a lot of growth.
Now, Peter, just a quick last question, and we have to talk about Hong Kong.
Of course.
Of course, the regulators and the financial secretary imposed a 15% special tax on people buying in that are non-locals and corporates. What has this done to the Hong Kong property market, and how do you see it for 2013?
It's had a very dramatic impact on volumes of transactions, for sure. The volume of transactions in December was down to just over 3,000 per month. Typically, Hong Kong's averages run at 7,000 or 8,000 per month. So we've seen a very sharp fall in the numbers of transactions. For sure, it's had an impact. In terms of pricing, not really. Prices have sort of stabilized. It's down a bit, up a bit. So it's not really had a big impact on prices so far. The underlying problem is supply. We have a shortfall of supply. There's full employment, 3.38% unemployment, wages and salaries are rising, plenty of liquidity, so the market is well underpinned despite the policy.
Thank you so much, Peter, for joining us this morning. We've been speaking with Peter Churchouse, author and publisher of Asia Hard Assets Report. Now, of course, CNBC's cash flow coming up at the top of the hour. Oriel Morrison is back now with a